It has been a roller coaster ride for global stock markets amid a tariffs blitz imposed by U.S. President Donald Trump on April 2nd. It's now 6 days later, and Washington's latest round of levies took effect just hours ago. U.S. tariffs on Chinese goods now stand at 104%. Here to help us make sense of it all is Post Managing Editor Eugene Tang. Eugene, what do you make of the market reaction so far?
Well, the market obviously is panicking, both from the severity and the duration of the tit for tat. So over the past few days, the market has veered from outright panic to a little bit of relief because they saw the so-called national team, which is a collection of Chinese sovereign wealth fund and their units coming into the market to pick up stocks and to prop up the market. They saw some relief, and then as the retaliation from the White House came, there was more panic. So it's really been a roller coaster ride, and it is something that will not stop for the foreseeable future. We probably will see a lot more volatility in the markets. Take, for example, yesterday, I know the S&P 500 in the US veered in a range of about 2,300 points. That means it went from up to down to up over 2,300 points. Wow. That's a huge range. And that is probably something that you will continue to see, not just in the US market, but throughout the Asian markets for the days to come.
Yeah, so Asian markets seem to have been hit particularly hard. Why is that?
Well, if you look at the 14 major stock markets around Asia Pacific, almost every single one of them would count the United States or China as among their biggest trading partners. So obviously when you've got the two largest economies in the world and the two largest trading partners of most of these economies fighting each other, they fear being caught as collateral damage, and they have indeed become collateral damage in this tussle. And that is why you've seen not just stock market plummeting, but currencies plummeting across the region. The Thai baht and the Indonesian rupiah are at the worst this year. The Korean won has weakened to its lowest level since the global financial crisis in 2008. So that's a huge across-the-board slump among emerging market currencies. But it's not just these currencies. The US dollar has also fallen, oddly enough, or not oddly enough, but as you would expect, because if the US is going to cut off its trade with the rest of its trading partners, its currency is going to weaken as well.
Now, the mainland has rushed to stabilize its markets. What has it done so far, and what further ammunitions does it have?
Well, the Chinese government has quite a lot of tools in its toolkit, in its policy toolkit. Let's just talk about financial resources to start with. Finance-wise, the Chinese government, the sovereign wealth fund is what, 1.2 trillion US dollars. That's 1,200 billion US dollars worth of funds. That's a lot of billions, right? It has been deploying a few of its units to come into the market to prop up the market and buy some companies that it sees as valuable. So for example, one unit called Chen Tong has disclosed that it's deployed 100 billion yuan worth of funds to prop up the market. There will be a lot more of these. But in terms of fiscal policy and monetary policy, the central bank and the government of China have various tools available to help industries overcome this period of disruption, of trade disruption with the United States. And in terms of monetary policy, the central bank has some room to cut in terms of reserve, the money that commercial banks need to set aside with the central bank. So that will release more funds to go into the market to stimulate the economy.
Interestingly, so far it seems like the mainland markets, among the few that haven't dropped yet since the 104% tariffs took effect.
It's up and down, and of course the investors are, I guess, felt a bit of confidence because the state funds are there to back up the market.
What about Hong Kong? Do you think the government will have to intervene at some point?
Maybe not directly in the stock market, because that's not what the government does. But what the Hong Kong government has done in the last couple of days is to make it very clear that the government stands ready to help SMEs in particular, exporters, companies that rely on this cross-border trade between Hong Kong and the rest of the world. Hong Kong is a free port, and the government is put its resources behind with upholding Hong Kong's status as a free port. So one of the biggest priorities is to support the exporters and support the small medium enterprises that are being affected by this tussle between the two giants.
Mm-hmm. So after the bloodbath so far, do you think is worse yet to come? Are we in bear territory?
There will be a lot more volatility over the next few days, weeks, or even months. The market is reacting badly. Several markets in around Asia are already in bear market territory. S&P 500 is on the brink of bear market. The Kospi in Korea is heading towards a technical bear market. I think the Nikkei 225, the TAIEX, the Jakarta index, the Stock Exchange of Thailand index are already in bear market territory, and it will probably remain so for the foreseeable near future until we get some clarity, and until the sort of tit for tat measures settle down, or until both sides come to the negotiating table. Right now, we don't see any signs of that happening, so we'll probably see more volatility ahead.
Right. Thank you. Thanks very much, Eugene. For the latest market developments, please visit scmp.com.